Hello, and welcome to this presentation on business responsibility and sustainability reporting, commonly known as the BRSR framework. In this presentation, we will talk about the industry standard note, which was released a few months back. Let me give you a brief background first. In October 2023, SEBI formed a consortium of the three industry associations, namely the ASSOCHAM, the FICCI, and the CII. This consortium was called the Industry Standards Forum. This forum comes up with standards on the various aspects of LODR regulations. We all know Regulation 34 of the LODR is about sustainability reporting and talks about the BRSR. We are in the second year of mandatory reporting under the BRSR framework. In this presentation, we will see how the industry standard note tries to handhold the companies who have just started their journey in sustainability reporting. So let's dive in. My name is MNS Pawan Kumar. I'm a chartered accountant. I'm a GRI certified sustainability professional and an ISO 14064 lead verifier. Let us first understand why these industry standards were issued. There were three objectives. A was standardizing few things. B, clarifying few other things. And three, the most important, was guidance on greenhouse gas accounting. So this note standardizes the data for certain KPIs like purchasing power parity and full-time equivalent for intensity calculations, how to report water consumption in places where there are no water inlets and outlet meters. It clarifies certain terms like what constitutes a data breach, what is the definition of wages, and what is the amount spent in employee welfare measures. And it guides in greenhouse gas accounting by using carbon accounting proxy method, also known as spend-based method. The carbon accounting proxy method would be used to calculate the scope 1 and scope 2 emissions of the entity, which is mandatory. Let us take up these aspects of the note one by one. First is intensity-based calculations. So entities have to report intensity ratios for greenhouse gas emitted, water consumed, energy consumed, etc. Now there are three intensity ratios: intensity per rupee of turnover, intensity per $1 million USD of turnover adjusted to purchasing power parity, and three, intensity in terms of physical output. We are looking at the disclosure under Principle 6 for greenhouse gas emissions for Tata Steel Limited. Here you can see Tata Steel has disclosed intensity under all the three categories. Now, there was a lot of confusion regarding purchasing power parity, how to convert the revenue in rupees to USD using the PPP, what should be the source of PPP, and there was confusion about how will service sector industries report intensity in terms of physical output when there is no physical output per se. Let us first understand the concept of purchasing power parity. We all know what is an exchange rate, which is $1 is equal to rupees 85, nearly 85 at this point of time. There is another exchange rate which is purchasing power parity adjusted. Basically, it is adjusted to the general cost and standard of living of the country. So the exchange rate, which is purchasing power parity adjusted for India, would be rupees 20.66 only. Now this rate is updated on an annual basis. Now this note has clarified single source of this purchasing power parity adjusted exchange rate, which is the IMF. So this note refers to this particular document, and the purchasing power parity rate should be taken from here, which is 20.66. So let's take an example. Let's say a company A had 10,000 million rupees as the revenue in 24-25 financial year. So using the purchasing power parity conversion rate for 2025, which is the latest, we get the purchasing power parity adjusted revenue in US dollars as $484 million. Now this will be used for the calculation of intensity. Let's say that the greenhouse gas emissions for this company was 20,000 tons of carbon dioxide equivalent. So using the PPP adjusted revenue in million dollars as 484, the intensity for this company A would be 41.32 tons of carbon dioxide equivalent per million US dollars. The second concept was specifically aimed at service organizations where there is no physical output. Here we are looking at the BRSR disclosure of greenhouse gas emissions for HDFC Bank. So you can see the note here. It says HDFC AMC being a financial services business, emission intensity in terms of physical output is not applicable to the company. Now this note says that such service sector companies should use full-time equivalent as their output and present their emissions intensity under this parameter. So what is full-time equivalent? Let us take an example and understand. Let's say a service sector organization has 3 employees who are full-time in nature and has 5 employees who are part-time in nature. On an average, keeping an average of 40 hours per week and 52 weeks in a year, the total number of hours available would be 2080. In this example, let us calculate the full-time equivalent employees for the company for a particular year. So let us say employee A works for 2000 hours in a year, employee B works for 1950 hours, employee C works for 2050 hours. The total number of working hours for that year would be 6000, sum of all this. Similarly, the 5 part-time employees work for various hours and the total number of hours by the part-time employees comes to 5700 hours. So total amount of work done by the full-time and part-time employees was for 11,700 hours. Now what is full-time equivalent? Full-time equivalent is this total working hours in a period of 1 year divided by the total number of working hours a full-time employee would work in that same period, which is based on an average of 40 hours per week, it will come to 2080. So the FTE, that is a full-time equivalent, is equal to 5.625. So full-time employees were 3, but full-time equivalent employees are 5.625. Now this is the denominator which should be used to calculate the intensity for this particular data point. Hope that clarifies. Next we come to carbon accounting proxy or the spend-based method for greenhouse gas accounting. What are proxies? Proxies are the filler data which is used where there are gaps in the activity data while doing greenhouse gas accounting. Spend-based proxies are used for estimation of emissions where the quantity-based information is not available. For example, the quantity of energy or diesel consumed is not available. In those cases, we use spend-based proxies. They are the expenditures which are booked in the profit and loss account, or there are other standard publicly available data, which we will see in the subsequent slides. Why do we need spend-based proxies? Spend-based proxies have been given by this note as a short-term guidance for standardized, accessible, and flexible carbon accounting methodology. These proxies are leveraging the audited financial data in order to estimate the Scope 1 and Scope 2 emissions. Most of the companies today are not ready with their quantitative data at the granular level. So this carbon accounting proxy helps to get them started with greenhouse gas accounting while they set up systems for getting the quantitative data. So as we said, when should carbon accounting proxies be used? They should be used only when the access to the granular quantity-based data is unavailable. And it should be phased out at the earliest date, the moment more accurate quantity-based data is available. How do we use carbon accounting proxies? The note gives us a step-by-step guidance. First, we will identify the expenditure data from profit and loss account. Then we convert this expenditure data to quantity data using a public pricing information which is available. So expenditure has been converted into quantity. Then we apply the appropriate emission factors from the IPCC or DEFRA or any other known database, and then aggregate emissions from all the relevant categories to form the Scope 1 and Scope 2 emissions. Let us take some examples and see. So how will we use the spend-based approach or carbon accounting proxy for Scope 1 emissions? So Scope 1 emissions are emissions which are attributable directly to the operations of the company. Let's say all the sources which are emitting greenhouse gases and are within the control and are owned by the entity will come under Scope 1 emissions. For example, company-owned cars, there could be some fugitive emissions, there could be emissions from the process itself, like aluminium smelting, cement clinkering, and stationary combustion, which is boilers or furnaces which emit greenhouse gases. So all these come under Scope 1. Now, let me be again very clear. Greenhouse gas protocol, which is the established standard for greenhouse gas accounting, does not permit the use of spend-based method for Scope 1 emissions. It is industry standard note which has given a specific guidance for the Indian companies which are reporting under the BRSR to go for the spend-based approach also for Scope 1 accounting only for the time being. So how do we calculate the carbon emissions? Spend data, which is the expenditure in the P&L, divided by the price factor, which is from an established source, into the emission factor, which is again from an established source. So what this note has done is it has given a list of fuels, which is diesel, petrol, CNG, and LPG, and has established a standard price for the financial year 23-24 and 22-23 for all these fuels. Using this price, the LPG expenditure which was booked in the P&L will be converted into the quantity of LPG, and using the IPCC emission factors, it will be converted into the amount of greenhouse gas emissions. Let us take an example. For the financial year 23-24, spend on LPG was 1,07,32,536. Let's say this is what was booked in the P&L against LPG. Quantity of LPG consumed would be 1 crore 7 lakhs amount divided by 96.51, which is the price of LPG fixed by the note, which amounts to 1,11,000 kgs. So the emissions from this 1,11,000 kgs burn of LPG would be 1,11,000 kgs into 2.98 which is 331,395 kgs of carbon dioxide equivalent. 2.98 is the emission factor of LPG, that is 2.98 kgs of carbon dioxide equivalent is emitted when we burn 1 kg of LPG. This is from the IPCC. Now let us take a look at the database which the industry standards note is quoting. This is an upload by the Petroleum Planning and Analysis Cell on 5th of April 2024, where they have given the retail selling price of petrol and diesel in the 4 metro cities of India. And it has come up with an annualized price based on this daily pricing. Now, what the note says is if the company has a better price factor, that is, if there was a bulk LPG order placed, so if the company can extract the price of LPG better from a purchase orders, that should be used instead of the price which has been set here. So if the company has a better source of data, it should be used for calculation of carbon emissions. Now let us take a look at how spend-based approach would be used for Scope 2 emissions. Scope 2 emissions is indirect emissions caused by the entity by purchase of electricity, heat, or steam for its operations. So the idea is the consumption of electricity by the entity causes generation of electricity by some other entity somewhere by using coal or natural gas, which causes emissions. So carbon emissions under scope 2 would be calculated similarly by extracting the electricity bill payments from the P&L, dividing it by the average price into the emission factor. The emission factor here comes from the published data of Central Electricity Authority of India. And for the financial year 23-24, the emission factor would be 0.727 kilograms carbon dioxide equivalent per kilowatt hour. This emission factor is also updated on an annual basis. So for 24-25 BRSR reports, the emission factor which would be the latest available emission factor, which is 0.727. Again, let us understand the scope 2 calculation with an example. Suppose for financial year 23-24, the spend on electricity was rupees 5,32,536. The average price for commercial connection for sanctioned load of less than 100 kilowatts for medium industries in Maharashtra is 9.13 kilowatt hour. Now, this has been given by the industry standard note. Assuming that the company in question falls under this category, the quantity of electricity consumed would be 532, 536 divided by 9.13, which is 583.28 kilowatt hours. So the emissions for 583.28 kilowatt hours would be 583.28 into 0.727, which is 42,000 kilograms of carbon dioxide equivalent. Having understood the spend-based method approach used for greenhouse gas accounting for scope 1 and scope 2 emissions of the company, let us understand how this method would be used for estimating the water footprint of those locations and offices which do not have a water meter fitted. Here, we will make use of the publicly available data by established sources like the Central Groundwater Authority. What the Central Groundwater Authority says is an average person requires 45 liters of water per day of work. So the water consumption in such offices which do not have a water meter would be the number of employees and workers in that location into the number of working days in that location into 45 liters. Now this makes the job of the company really easier to estimate their water footprint. Secondly, When the office of the company is located in a larger facility, and the larger facility has a water meter which measures the water withdrawal, discharge, and consumption. So we have the water consumption data at the facility level. Then the water consumption data for the particular office can be calculated based on the proportion of square feet area of that office compared to the larger facility. So the subunit level data, which is consumption, would be equal to the facility level consumption, including common area, into the subunit area in square feet divided by the total facility area in square feet. That is how we will calculate the water footprint. Before going further, let us take a look at this Central Groundwater Authority chart, which is quite interesting. Now, this is where it says that for offices and including canteen, the water requirement would be 25 liters for domestic purpose and 20 liters for flushing. So the total would be 45. So this is a complete chart for water requirements for buildings other than residences. This is an interesting document which the industry standard note refers to when giving this guidance. There is a data point in Principle 3 which says employee welfare measures spending as a percentage of revenue of the company. If you take a look at the financial year 23-24 BRSR reports, this figure varied from 0.01% to 10% in few cases. Clearly, there was a lot of misinterpretation of what should be included as an expenditure on employee well-being. So what this industry standard note has done is it has made it watertighter. It has given specific items which should be included for this particular data point, which are actual costs incurred by the company on health insurance, accident insurance, and daycare facilities. The cost of maternity and paternity benefits, which is given to the pregnant mother, and the actual salary paid to the employees during their maternity and paternity leaves. Thirdly, the costs incurred by the company on health and safety measures, including mental health, on doctors' annual health checkups, any medical benefits given, or fitness programs which are sponsored by the company. Most importantly, only those expenditures are eligible to be included which have been charged to the profit and loss account. Now coming to the other aspects which have been addressed by the note, definition of wages. The wages have been used a lot in a lot of places in the BRSR framework. Wages paid to the female employees, wages paid in rural, urban, semi-urban areas. So definition of wages now has been clarified as salaries, wages, and bonus as per the disclosure made in the audited financial statements, but excluding retirement benefits, ESOPs, and staff welfare expenses. Now, there is a data point in principle number 5 which says the organization has to disclose number of complaints received under the prevention of sexual harassment against women divided by the number of female employees in the organization. Now, this denominator has to be the average number of female employees during the year, which will be the opening number of female employees plus the closing number of female employees during the year divided by 2. That clarity has been issued now. Similarly, with respect to job creation in smaller towns, which is a disclosure in principle number 8 for inclusive development, wages paid in specified locations include the total contractual payments for labor in that specified location. So it will not be just wages paid to permanent and other than permanent employees, but also contractual payments. That clarity has been issued in the note. Now we come to the definition of data breaches. In principle number 9, companies have to disclose the number of data breaches where the personally identifiable information of customers were compromised as a percentage of the total number of data breaches. So, what constitutes a data breach has been clarified in this note. A data breach will be considered for disclosure when such cybersecurity incident has been reported to the certain, which is the Computer Emergency Response Team, which is a flagship organization for all cybersecurity related incidents in India. Now, out of such incidents which have been reported to the certain, all those incidents which involved the personally identifiable information of the customers will be disclosed in principle number 9. Next, we come to the definition of input material and total purchases. There are at multiple places where the terms input material and total purchases have been used, like in principle number 1 in openness of business, and again in principle number 8 where the companies have to disclose percentage of purchases from within India. So this note reiterates that the definition of total purchases and input material would be all types of procurement, including raw materials, spares, services, capex, everything, and third party services. Apart from these aspects, there are certain minor aspects related to related party and some others were not that significant to be included in this presentation. In conclusion, I would like to say that this industry standard note is a welcome push to all the companies who have just started their sustainability reporting journey to get the ball rolling for these companies. Thank you.